Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, September 8th, 2023, and this is Blockhead Traders Weekly. In this week's episode, I'm joined by fellow Blockhead trader Viper XL 007, and we are going to look at three topics here this week. First one, we're going to touch on a few little crypto updates as far as what's happening in the world of regulation. Some interesting court cases have kind of surfaced recently. We'll just briefly touch on those. And then we want to hop into the meat of this episode, which is about transaction revenue. And you've heard Viper and I talk about, being the pipes that carry the water, or being part of the thing that makes the transactions go, the visas of the world, right? Visas collect transaction fees no matter if consumers are doing well, poor. As long as transactions are going, they're generating revenue. And so we are going to look at basically market making or trading bots. I'm hesitant to use the term market maker because in a lot of cases, we're not going to be throwing around enough capital to really make the markets, let's say. But there is a trading bot strategy that we can deploy that will basically try to profit on simply the transactions that are going on the network, the difference between the bid and the ask, just making kind of pennies on those little transactions, but doing enough of those with enough frequency that you can actually become profitable. And so we'll touch on the very beginnings of this. It is an open source application called Hummingbot. Viper has been trying to get me to be interested in it a little bit, and I am going to start dabbling in there. So this week we're just going to introduce the concept and kind of just get something running really quick. And then in a future episode, we might dive in a little bit more. But before we hop to that, I want to give a shout out to our Discord, a link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. You'll also find a link at thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Lastly, you can pick this up in an audio format wherever you get your podcasts. And if you try to look for us there and you can't find us, let us know and we will get it there. But let's hop to this week's content, Viper. Viper, I think we're going to touch a little bit this week back in the crypto space because there's a few different articles and court cases that kind of surface that are starting to, crack the door a little bit more and shed a little bit more light on some of the topics that we've kind of talked about historically on here. And I just kind of want to, touch on that just briefly. So you want to mention about some of those? I think you were reading up on them.
Yeah. So there's I think there's a lot of cases out there, but there's two in particular that have caught my attention and kind of the whole space's attention. Obviously, anytime there's a court ruling that could even remotely be considered "quote unquote" in favor of crypto or anything that's not SEC, we'll put it that way. Any ruling that happens that's not in favor of the SEC. The space goes wild with it's a huge victory, it's and so we're obviously going to temper that a little bit. But there are some interesting aspects to these two particular cases that I think are worth noting. So the first case is it was actually Uniswap. So Uniswap is a popular Ethereum network-based DEX, decentralized exchange. They were being sued by some plaintiffs. I forget exactly if it was an organization or whoever, but they were being sued basically saying Uniswap listed scam tokens on their exchange, and they lost a whole bunch of money because of it. They bought it, the token rugged, and liquidity was pulled or whatever happened, and they wanted to sue because they lost a bunch of money, and they thought Uniswap should verify these tokens and have a better oversight on what gets listed on their exchange. And so the end result was the judge was pretty pretty, I don't know, adept or aware at the mechanics at play here. The judge definitely did not approach Uniswap as a judge might approach a centralized exchange. And so there were a couple of interesting things that came out of the ruling. First of all, the case was completely dismissed. The judge was not too happy with the claim from the plaintiffs. And the judge quoted basically saying, hey, this is a decentralized exchange. And there was a lot of language that, indicated that there was a lot of understanding from the judiciary of this is something that's not correlated to a centralized organized body, even though there was still quotes in the ruling of nobody sues the New York Stock Exchange when, something bad happens, to a particular investment that somebody makes in there. So there was a little bit of that. But ultimately, the judge also clearly stated, given the current regulatory environment and guidelines for a decentralized protocol, my hands are tied. This is something Congress needs to take up. And I think it was even specifically called out to that degree of explicitness to say the current guidance from the SEC on how to handle this is not sufficient for me to make a ruling here. So I'm dismissing it, yada, yada, yada. And I thought that was interesting because we've talked about that on previous regulation episodes about how all of the regulatory guidance we have gotten so far is very focused on a centralized entity and what the rules are for that centralized entity. And we've, when we went over the big one a few episodes ago, it even said at the bottom that there needs to be a task force to go out and really investigate decentralized finance and all that kind of stuff. So it was interesting to see that upheld in a very consistent way for that judge to be aware of what was at stake with the defendant and Uniswap and say, hey, this is a bunch of code. This is a whole decentralized world, and we don't even have the tip of the iceberg here. So no, there's no case to be had here.
Yeah, that's I think it's great to kind of get more of those call outs there. Gets kind of people talking, and you get people kind of framing like you said, the terminology and the mechanics behind it. And it just raises kind of awareness because everybody seems to have their ears perk up when somebody says crypto this, crypto that, court case this, court case that. And I think it's just this slow slog and chipping away at it before the nut will finally crack open.
And so the second one that I just wanted to touch on real briefly, because this one might have made a lot more headlines, maybe even some evening news. The Uniswap one, I think that kind of got, just kind of was in the space a lot, but didn't bubble up too high. So the bigger one was Greyscale had their Bitcoin ETF, spot ETF, rejected from the SEC. Greyscale went after the SEC and sued them and said this was unfair. You rejected our spot Bitcoin ETF without due grounds or anything like that. And so just a real quick backup as to why this is significant. Because, we did a whole episode. I literally have a trade on that has been on for a month now where I bought Bitcoin futures on the New York Stock Exchange. And so what's important about that is that was Bitcoin futures. That was a leveraged ETF on Bitcoin futures. That was not a spot ETF, where a spot ETF is I buy one share of the spot ETF, and whatever that share price is goes and makes a Bitcoin purchase of the same exact size, and therefore my share is backed by Bitcoin itself, and so it's a spot purchase through an ETF stock. And so none of those have ever been approved yet. They keep getting denied. They keep getting rejected by the SEC for listing. And so in this particular case, the judge was actually pretty aggressive in the judge's language towards the SEC to say that the SEC is not being consistent at all with the fact that the SEC has approved, I think it's at least 2 Bitcoin futures ETFs, but then consistently will deny these spot ETFs. And so the judge ruled in favor of Greyscale, which does not mean that the ETF can be listed, but it does mean the SEC's denial of it is null and void, and Greyscale can go ahead and reapply. And I assume that means the SEC can't reject it on the same grounds that they did before. I don't know if that just means they'll find something else to reject it on. But it was an interesting stance, again, from the judge to basically say, this isn't making sense why you allow these Bitcoin futures. And the SEC in the last couple of weeks has even admitted that the leveraged ETFs pose a greater risk to consumers rather than a spot ETF would. So the main significance here to me is that it's just this frothing of the waters of, we're on the cusp of these spot ETFs being approved specifically for Bitcoin, but there are some Ethereum ones filed as well. And then there's a whole trickle down ripple effect that could have on the crypto markets once people are able to get crypto exposure through their brokerage accounts, through their equities accounts, and all that sort of stuff. There's all sorts of speculation on what that means. I think we've stayed decently away from what we think will or won't happen, because it's all speculation at this point as to what that will look like when it happens. But again, interesting to see a judge kind of like, I don't know. I mean, everybody wants to spin it of like putting the SEC in their place and yada, yada. But more than anything, just highlighting the inconsistency here, which I'm sure I've mentioned on the show before, because I thought it too. I was like, why do we have a leveraged ETF, but then you won't let a spot ETF go through? I don't see how there's consumer protection concerns in this situation. So bringing us ever closer to the infamous and mysterious unicorn of a spot ETF approval.
Yes. And actually, this whole spot ETF thing, I think, kind of ties in a little bit to our next topic as well. And I think it's just this constant, pick. And maybe someday we'll look back and people will be like, wow, why did it take so long to arrive at what will at that moment be an obvious conclusion, I feel, after years and months of kind of wiffle waffling and dodging around there and this, that, and the other thing. And people will be like, what was wrong with everybody? Why did it take so long? And we're not there yet, but we're on our way there.
Yeah.
And I know one of the interesting commentaries that I read about a spot ETF is, spot ETF basically means the holder of the ETF is actually investing in the underlying token, the underlying asset itself directly, not through any sort of futures product or things like that. It is the spot price. And that, once it's finally approved or goes through there, it's kind of like taking something from a mom and pop store where, a couple of craft, people that connoisseurs of craft coffee or craft breweries, right? They know how to find them, and then becoming the Budweiser in the grocery store, like the mass produced, mass available, every supermarket out there. Back many, many years ago, that was, when once a product was featured in Walmart, oh my goodness, volume went through the roof, maybe profits shrunk or things like that, whatever that was, but that was really just kind of opening it up to the masses. And I think that spot ETF, once it's out there, will largely drive a lot of volume on the underlying asset of whatever that happens to be, Bitcoin or whatever it's a spot ETF for, which is actually the tie-in to the next topic of a trading bot, because the idea of a trading bot here is you're going to capitalize and profit on the trading volume of a particular exchange, whether that be centralized, decentralized, doesn't matter. So the term market maker bot, market maker is kind of thrown out there. Because if you think about it, what a market maker is doing, and I'm going to use the term market maker here for the example, but I think you could argue whether or not this actually is making markets, because I think a true market maker really has to have enough capital to make a discernible difference in the liquidity of whatever it is they're making a market for. And Fundamentally, all that a market maker does is they step in and they buy when nobody is buying and they sell when nobody is selling, right? They're basically facilitating the transactions to occur. And so if you have a particular asset that's trading, some guy wants to sell at $2 and some guy wants to buy at $1. Those are your bid and your ask prices, and they're $1 apart. And nothing's going to happen because this guy wants $2 and this guy wants to only pay $1. And so those markets would be considered illiquid. So what happens is a market maker will step in and he will offer a price somewhere between those two and say, you know what, for $1.50, I will buy it for $1.50. And then maybe the guy that's trying to sell it for $1 says, you know what, okay, fine, I'll take it for $1.50. And so, boom, he sells it for $1.50. Now this market maker has it, and he wants to turn around and sell it. And he knows there's a seller out there that will sell for, $2. And he says, well, you know what? I'll sell it to you for $1.75. It's not the $2 that you wanted it for, but we'll $1.75. Maybe that person says, you know what? Okay, fine. I'll go ahead and do that. And that market maker just made profit on the simply stepping in and helping brokerage the transactions there, maybe to the same people, different people. But they made 25 cents on that because they were able to pick it up for $1.50, sell it for $1.75. And they created movement in the market. And that's effectively what a market maker is doing, is they're trying to profit in the difference between the bid and the ask.
Yeah. And I would say, because I completely agree that in the context of what we're about to show, it feels like playing fast and loose with the phrase market maker. There's I don't know. There's a couple ways that I'm okay using that phrase, because in the scenario you just gave, you have what's called the spread, and so that is that initial scenario of the $2 and the $1. You have $1 spread there, and the idea where I'm okay using the phrase market maker and what we're about to see is, as you laid out, like the goal of the market maker is to shrink that spread. Such that it gets small enough that both parties are happy and they're like, okay, fine, here we go, let's roll, and the market moves. So in the context of where this plays into the world of crypto and decentralized exchanges, or even potentially centralized exchanges, but there's more of a hive mind effect where all the little people can get in, run a bot. And so, yeah, individually, I don't contribute a significant volume, but as a hive running, the different bots and different strategies and stuff, we kind of collectively represent a larger portion of capital, and really help shrink that spread there. So, in one particular case, the exchange we're going to be looking at, again, disclaimer that we put before everything, there's nothing that is a stamp of approval of like, did we endorse this or whatever, because it's the Wild West world. Who knows what's here today, if it'll be here tomorrow, all that good stuff. But the exchange we're going to be looking at is kind of amplified in this shrinking the spread and less capital having a bigger effect because it is a brand new exchange. Therefore, it is still trying to attract liquidity. And so you can, with a smaller amount of capital, you can have a larger effect on that spread. So some context to why in this particular example, I'm a little more okay with using the phrase, but yeah, something in the stock market, like nobody with less than, I don't even know, $1 billion is going to be able to move the ticker and actually sweep those orders like you were describing.
Yeah, and there's another concept that we're going to kind of maybe just briefly mention today. We won't dive much into it in the crypto space, because what we're going to show is kind of a market making or trading bot in a crypto decentralized exchange. But like Viper said, some of these decentralized exchanges are young. They're trying to become, get people to grow to them. And the only way to get people there is to get good, fair pricing. The only way to get good, fair pricing is to have high liquidity. That fair pricing, that market liquidity is what makes markets efficient, and the more efficient a market is, the more fair the price is, and so there's incentive to want to do that or draw market makers or liquidity to them. And these places will offer rewards for participating in buy and sell transactions. Now, the parallel to that in the equities world is you might have heard of the term payment for order flow. We're not going to jump into that, but it's essentially a similar concept where particular brokerages or clearinghouses will collect some fee from the brokerages in order to route orders through them, which then allows them to, hunt for the wide spreads, which allow them to basically then profit by shrinking the spreads. It helps the market because they're now providing liquidity where liquidity is needed the most because the spreads are the widest. They're shrinking them up. And so that same concept is going to be here with this trading bot that we're about to talk about. The last piece that I kind of want to mention before we start talking in and dropping names and showing some examples is historically, I think that my position on a lot of investments is I want to try to remain as passive as possible. When I do my premium selling, I like to have what we call delta neutral. I want to keep the risk very low and basically just profit on theta burn, time decay, insurance premium, that type of stuff. We've talked about in the past where I want to become a validator on a crypto node. What does a validator do? They just run some math to say, yep, this transaction checks out, and they collect a small fee for their participation in validating that transaction. That's the analogy I gave earlier in this show to the Visa framework, where Visa collects a fee from every merchant that charges a transaction. And that's how Visa makes their money. It's just a small fraction, a percentage of the sale, but many, many times over, it adds up to something larger. When we go into the trading bot, the philosophy that I want to take here is not looking for certain patterns to catch certain swings or things like that. It's not that type of trading bot. The trading bot, and from the perspective that we are going to cover it and that I am going to dig into, is that idea of profiting from the spread. So you find a wide market, you participate by putting some liquidity in that market, which is basically you're having your bot basically enter buy and sell orders with some distance of percentages and things like that. So again, it's that delta neutral mentality where you're creating passive income from something that's going to happen to transact. Up, down doesn't matter. All that matters is that volume and liquidity is going on.
Yeah. So let's jump in here and let me set the stage for where this bot is going to be operating, and kind of just a real quick look at that spread situation that we were talking about. So if we jump over here to my screen, we see this is the DEX a lot. So this is the decentralized exchange. We talked about them before. They're trying to build a platform that's more familiar to a centralized exchange, so it looks more familiar, all that sort of stuff. It runs on an order book rather than a liquidity pool. Like we've talked about liquidity pools before. This runs on an order book, which is exactly what every brokerage, everything runs on in the equities world. So that spread we were talking about, if we're looking at the trading pair of Bitcoin and USDC here. So this is basically Bitcoin and $1. And you can see that the current order spread is $9.70 wide. So between the first person who wants to sell and the first person who wants to buy, and you can actually in real time here, you can see that spread jump around as these trading bots or market makers are trying to squish that spread. So it kind of took my argument away from me right there, but it was there. We had it, and I'm sure it'll be back. It was $9.70 wide, but even still, even at 60 cents wide, that's still a pretty wide spread. Because if we go over to a centralized exchange and we look at their spread, we're looking at the first person that wants to sell is $25,746.06, and the first person that wants to buy is $25,746.05. So we're talking less than a penny on the spread here of Bitcoin on a centralized exchange. And the total value on the books, just at the first order book here, just at the first order fill, there's $350,000 at the 6 cents. And then on the buy side at 5 cents, there's $174,000 just sitting on 5 cents. And so, going back then over to DEX a lot here, you can see we still have our 60 cents spread. So we're a factor of, what is that? A factor of 10 larger? No, even more, 60. A factor of 60 larger on our spread here. And then the money sitting on the book, we have on the first order here, $2,000 and $2,500, and on the first buy, $2,500. So right away, that gives us just a brief look at, this is why I was saying there's less capital making a larger impact here on DEX a lot to shrink this spread. There we go. Spread's back to $10.80. So there is now, to be more of a quote unquote true market maker, or don't worry about true market maker, but just arbitrage opportunities, because you'll hear about arbitrage in all sorts of different contexts. The very high level gist of it would be, hey, there's a $10.80 spread here. I could buy Bitcoin at this particular price, which is $25,763.70. I could bring that over here, $25,743. So I could buy it there. I could bring it over here, sell it, and make a really rapid profit. And that would be arbitrage, because I'm arbitraging liquidity between these two markets. That's beyond what we're talking about, but that is a thing. That is a strategy that the bot that we're using, Hummingbot, has cross-market strategies to do exactly that. And then at the big picture, that's what helps kind of stabilize pricing across all these exchanges. And when you have all these arbitrage opportunities and people are buying here, selling there, and it kind of ends up keeping the price mesh similar across the board.
Yeah, so let's kind of quickly jump over here to this open source project called Hummingbot, which you kind of pointed out to me as this open source project that's I'll call it the largest standard out there, or at least when you start looking for trading bot projects, the Hummingbot really stands out. And I guess I'll give a little intro here to this. I don't know a ton about it. I started messing around with it this past weekend. I plan to mess around with it a little bit more to basically kind of flesh out a very basic strategy, and then I want to talk through some of the mechanics of it. But effectively, this is pretty close to point, click, run, and then tweak a little bit. So it's very approachable from a beginner standpoint. Although I won't say it's just absolutely over the counter, as you'll see, we're going to go through and on how to click and run it up a little bit. And so there is a few aspects you kind of have to know a little bit about. But they package this thing up in what's known as a Docker container. And we won't get into, what exactly is a Docker container, but you can kind of think of it like a small little capsule of program that you can run on your computer. And then inside that program has all of the logic and all of the latest code to execute this particular trading bot. The cool thing is it's open source, so you actually can go to the source code itself. If you're a techie nerd like me, you can look under the hood. You can see how it works. There's no black magic there. It's fully transparent. You can contribute. You can then extend this to do other neat things if you're technical and so inclined. But at the most simple level, you can download it and run it. And then they have kind of a drop dead, hey, we're going to ask you a couple questions, and then whew, you're on your way to having a trading bot. And then what I want to dive into is I want to start with this very simple off to the races. And then I would like to try to tweak and mess with from there different things. And so, Viper, tell me a little bit about pulling this thing down and getting it running.
Yeah, so we're gonna go through just some of the quick setup steps as to how to get this thing going. And like Sprocket said, like this is hardly the end game here. Like what we're about to do is just the bare minimum. There is so much that even as I've been running this for 4 months, there's so much I still want to get into with the strategies and things like that. However, like we said, it's a balance of your goals. My goal is to provide that shrinking spread liquidity and execute trades that, just kind of build volume on this particular exchange because there are good rewards that I'm earning through that. So that happens to be my specific strategy. That's kind of a niche strategy in the big picture of things because you would want a more robust strategy, maybe that cross-market thing that I was talking about. But the only point here is that there's so much more to this that you can do that we are not doing. But it all starts with this setup here. So the very first thing you do is you pull the GitHub repo because, like Sprocket said, it's open source. It's listed on GitHub. You can conveniently pull that in with a command. And once you pull it in, you have some files here and some configuration to do. So the very first thing you want to do, and this is, assuming that you have some experience with Docker. As I've explained, setting this up to people, or any technology endeavor, even if you don't think you're techie, but you might be curious, ChatGPT, man, that is your buddy through all this kind of stuff. You just, hit an error message, tell it what you're trying to do. ChatGPT knows about Hummingbot because it's been around for quite a while. It is by far way better than Google searching anything. So feel free to dive in and just fire up a tab of ChatGPT and have a conversation with a robot. So you have Docker installed, you pulled in the repo. The first thing we do is a little Docker compose up-d, and we're kicking off here.
And what that's doing is it's reading in the directory you're in there. There's a docker compose.yml or YAML file, which is effectively a set of instructions. And that's what you're pulling down from GitHub is instructions on how to start this thing. And so that's part of the magic. When you're talking with ChatGPT, you can learn about YAML files in Docker Compose, which is effectively like a script to start up a Docker image.
Yeah. And so we can see that we have green. Green is good. Green is go. And your names, may be different, but these are important names here. The container names, the Hummingbot are the actual bots that we want to set up. We're only going to do one of them, so we're just going to pick off this show 22. The gateway is a separate container, and that's how we're going to connect specifically to a decentralized exchange rather than a centralized exchange. So once you got green, we just do a Docker attach. So now we want to take this viewport of this terminal here, and we want to attach it to the Hummingbot. And in our case, we're going to load up the show 22 bot. So we do that, and boom, now we're just going into configuration mode here, where we're getting this thing set up for the initial run. It wants us to put a password in, and this is to password protect launching the bot, in case the computer is shared or, any other reason for such security. So we're just going to throw in a super highly secure password here, and we're essentially in. I'm going to hide this log pane because there's a lot of errors. It can feel pretty intimidating. We don't actually need this. All of that's going into a nice fancy log text file if we ever need to call on it. So now we're in. We have Hummingbot here. We have some beautiful ASCII art. And the very first thing we want to do is, in our particular case, we want to connect to a DEX, a decentralized exchange. And like I said, that references the gateway container, the gateway piece of code, which, and just a quick explainer on that. If you want to connect to a centralized exchanges open up what are called APIs. And so that is an application programming interface, which they give you specific commands that you're allowed to run on their servers to return certain information. Now, when we go into the world of decentralized exchanges, those APIs don't exist because there's no centralized entity to provide that, and we're on a blockchain, and it's kind of the blockchain itself that has the APIs, which is to say, hey, here's a contract. I want to make this particular buy call or this sell call against this contract. So the gateway fills that void. It is the conduit between our bot and executing trades on a blockchain API call, essentially. So the very first thing we have to do is we need to generate these SSL certificates for the gateway instance itself. So there is a gateway command which invokes the gateway rather than the Hummingbot instance. So we just run this gateway generate-certs. And again, just to back up so you can see, there is some autofill text so you know if you're doing the right command. So when I type gateway in space, here's all my choices. You can see generate certs is there. So as I type that out, it's there. We do that. And so we need to put a passphrase to encrypt our SSL certificates with. So once again, super, super safe password. And now we've generated these certificates. Now they are generated out in the certificates file that the Hummingbot loads on initial load. So we actually have to load these certificates into the bot. We have to exit out here, shut it down, and then start it back up. So we bring it down with Docker compose down. You can see that we're stopping this, and the Hummingbot and gateway instances are removed. We'll just wait until we get green for good here. You probably won't see that resource is still in use. That's because I have other bots still running. So we have that. Before we bring it back up, let's do a little bit of coding. I mean, it's even hard to say it's coding. It's just uncommenting some stuff. But in our config file, so this is that YAML file that we talked about, the Docker compose YAML, you'll see these green lines. So these are commented out. A comment is simply just saying, hey, skip this line as the code is being read, skip over this. Now we want to not skip over this. We want to put our passwords in here. The password that we generated at the very launch of the tool, and that's just like when you log into your email and you say, remember this password. That's essentially all we're doing for these first two. So we delete these two lines, and the formatting is particularly important in the YAML file. So we're also doing 2 deletes here because you want everything to line up as it is. And so the config password here is, again, this is the save my password when we log in. There you go. Now everybody knows my super secret password is actually test with a capital T. We put that in there, plain text, make all the security guys cringe. And then we come down here, delete, 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 delete. And this is what we encrypted our certs with on the gateway. Once again, test. Awesome.
And they don't have to be the same password. You can set them separately and should set them separately. And you should not use the word test.
Should. And it's also important, like, I mean, when you're seeing, like, we don't really have too much of a choice as far as storing this password in plain text. So this whole endeavor, like, you need to be aware of what your exposure risk is here. And so this is obviously not a password we're using anywhere else. This is a unique password we've generated for this exact instance. And then later on, this concept will come up again. But for now, we save that, and we get that out of the way. And now let's boot it back up. Same thing, Docker compose up D.
And the dash D is just keeping it in the background as a daemon.
Yeah, which is... So when we attach, we kind of bring it back to the forefront. So if you ran it without the dash D, it's a pretty big mess of unformatted text flying across the screen.
Don't do that.
So we're going to Docker attach back into our Hummingbot. Show 22 is the one that we configured. Now it's not going to ask for that password because we said save it and just blow straight past it and we're in. Now, important up here, we see gateway is online. Great success. That just means that it's up, it's running, it's connected, all good there. So, but we can't just run it yet. We haven't told the bot where to go. We haven't directed it to anything yet. So, actually, we haven't connected it to our wallet either. So what we want to do is now use that gateway command again, because now in our particular case, DEXalot is the name of the exchange we want to connect to, the decentralized exchange. So we need to point our gateway to DEXalot. So we say gateway connect, and DEXalot is one. I mean, you can see the options here. These are other decentralized exchanges. In our particular case, DEXalot is where we want to go. So we run this, and it's going to ask us some configuration questions. These are, if you know DEXalot, these other answers make more sense. So which chain do you want DEXalot to connect to? And it's giving us the answer right there. It's not a test. Avalanche, and which network. We want to use the DEXalot network because it's running as a sub network on the Avalanche chain. We come down here. Do you want to use this node URL? This is the RPC connector to the DEXalot subnet. Once again, we're just going to say yes. There's nothing else. I mean, this is like a security checkpoint. We can make sure that we're not being asked to connect to something we don't expect. You can find this RPC code, RPC link on the DEXalot documentation, just so you can verify that you are trying to connect to where you think you are. Say yes. And now this is where it wants to know our wallet private key. So now we're back to the whole plain text, know your risk exposure and all that sort of thing. We're using a self-custody wallet here, and your private key is a very special key. There's two very special things in a self-custody wallet that you need to know. One is your seed phrase, and your seed phrase is what encrypts all of your stuff. And your seed phrase, never, ever, 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 ever does anybody need to know what your seed phrase is. The moment you give somebody your seed phrase, they have access to every single wallet that you've created underneath that seed phrase. Just never, 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 never. One of those things. The second thing is this idea of a private key. So you have your seed phrase, it generates infinite number of wallets that you want underneath of it. Each individual wallet has a private key, and you can share that private key. Let's be a little more specific. You shouldn't share the private key.
You can share it to the world.
It's private for a reason, because that private key will give ultimate access to that one singular wallet. However, in the case of an algorithmic trading bot, it has to have that, we'll call it admin rights to your wallet. It has to be able to sign transactions for you and submit them on your behalf. So that's why we are giving it the private key of one wallet that was generated underneath that seed phrase. We are not ever, no bot ever should ask for our seed phrase. We will never give it to it. It's just a bad bot. Don't do it. So in this case, we're giving it a private key for one wallet that we've generated underneath the seed phrase. But know your risk exposure. This is a wallet that I don't use for anything else except this bot. So that way my risk is mitigated. There are no other funds that could be siphoned out or stolen should somebody get a hold of this private key. So in this particular case, the key is a lot longer than this. But we're going to put that number in there. This is not actually a valid key. And then in this case, if there is an API key, there is not. So we just hit enter. And now we are set up, good to go. And now the wallet's connected, provided we had put a correct private key in there. So the power of magic and TV, we're over here. The wallet is in there. There's now an official private key in there. We just need to create a strategy for the bot to trade. So we're almost there, almost there. So there's a create command. We're going to run create. What kind of strategy do you want? So, I mean, there's a whole bunch of stuff on the Hummingbot documentation, all the different types of strategies you can run. This is where it gets really configurable. In this particular case, pure market making is the one that we want to run. This is just ladder listing or high frequency trades, that sort of thing. We just put in pure market making. The name of our market spot connector. We are using this DEXs one, which we just previously set up. So we're going to do that. Now, what's the name of the token pair? So if we jump back real quick to the DEXs website, it's basically asking us, hey, which one of these pairs over here on the left side do you actually want to trade? So in this particular case, I'm actually going to put in USDT, USDC, because this is, to me, a really interesting trading pair opportunity. Easy rewards, I would say, because you're trading $1 for $1. But they're two different dollars in the world of crypto that somebody might want to trade between, because you can see there's pairs with USDT or USDC. So, but the point is, it's $1 on both sides. So there's a lot less risk of impermanent loss or value depreciation on that. So USDT, USDC is the pair we want to trade. You can see that it preloaded there. We put that in. So now this is where we get into, forget the decentralized exchange that we're connecting to. This is just this is universal concepts here. How far away from the mid price do you want to place the first bid order? So you can configure based on whatever your personal strategy is, the mid price between the spread, well, the mid price of the spread, the mid price between the first bid, the first ask. How far away from that do you want to be? In this particular case, because it's $1, we actually want to be really close. So I'm going to put like 0.01%. And then same question for the ask order. We'll do just 0.01%. And then how often do you want to cancel and replace bids and asks? So we're just going to put 10 minutes, 600 seconds here. And what is the amount of the first order? So let's just do $50. Would you like to use ping pong feature? And again, when things come up like this, like I didn't know what this was, the documentation is superb. You can just search ping pong and you can find out what it is. In this particular case, no, I don't want to do that. And then we just put in a name for the config. So we're just going to call this show stables. And there, now we've saved that config. So in the future, when we come into our bot here, we don't have to go through all that stuff again. We just run the docker compose up-d, and then we would come in and we would say import, and here are our config files, and we would just say, hey, show stables. That's the one we saved. Load it. And now it's loaded. We run start. We answer a question, and we're off. And what you would see is over on the DEXs website. Let me bring up mine with bots already running. We would see our orders sitting in. So these little yellow dots over here, these are standing orders. So you can see in this particular case, I'm trading the ALOT USDC pair, and I have a sell order and a buy order sitting here. And in the case of what we just set up, every 10 minutes, it's going to take those orders off the books, and then it's going to replace new orders in. So the reason you would do that is maybe you just want to provide, in like in a price surge, like where price just runs really fast, but you don't always want to be, have your trades transacted or whatever your strategy is. Maybe you're 2% away from strike. So as price moves, say every 10 minutes, you're like, no, the price is, I want to redo the orders. I just want to try to stay 2% away from the strike price. Because it could depend on what your strategy is, but, that's the gist of it. We're up, we're running, and, we're making markets.
Yeah, nice. This is something that I plan to actually get up and running and maybe dive in a little bit more in a future episode, a little bit deeper with some of the methodologies, kind of pulling up the config files to see what's in them. But like, I mentioned, this seems like an opportunity here of being that uh, profiting on the transactions, not necessarily the direction. So it fits that methodology that I like to trade, that passiveness, that neutrality, risk neutrality, and I'm interested to try it out. So
Yeah. And I guess the other thing I'd call out is, because there's some interesting pairs on here. Another one that, there's you have to factor in volatility of what you're market making, because there is loss. In this particular strategy, there is loss because I'm not doing a whole lot of smarts on like counter, hedging a trade and all that kind of stuff. So the question should be like, why does the protocol want to reward me for this? What am I doing? What am I providing? And why am I being paid a reward for it in this particular case? And it's, because in the case of an order book, if somebody shows up to trade, like the protocol wants to be a destination just for traders. Like, forget about us behind the curtain trying to fill the order books and stuff like that. They want to attract traders to just show up and do some day trades, or just do some trade one of these pairs. But in an order book, if somebody shows up, and like we saw with the liquidity between this one and the centralized exchange, if people show up and there's $50 in the order book, that is not a good experience for your users, because that spread is going to be huge. They're not buying a good price because the spread is equatable to a good, fair price. So things like that are what motivate the protocol to pay these rewards for people for just having orders sitting on the order book. Because if the order is sitting there, that means it's ripe for buying or selling. And that is liquidity that makes the experience enjoyable for a trader that just wants to show up and make a couple trades.
So that brings us to the end of this week's episode. Touch briefly on some of the crypto regulation latest revelations with a couple of those court cases, and we'll keep an eye on it. We'll keep it. It's interesting. Kind of keep tabs. I think that once a lot of that stuff starts gaining traction and starts getting clarity, you'll definitely see a lot more flows of money and people dabbling in that, because I think it'll start to shed some of that risk aversion that is out there in the mainstream. And you'll start getting more and more retail traders participating in that. That type of thing will have a necessity for needing more liquid markets. And the way that liquid markets can be provided is really with anybody that's got a little bit of capital to throw at it. And, you might not be enough with the big guys, like on a exchange, like the New York Stock Exchange or things like that. But in this really kind of blossoming young world of crypto and decentralized exchanges, as Viper showed you, it really doesn't take that much capital to kind of be a major player on some of these decentralized exchanges. And if anything, it's an experiment, right? And it's not a guaranteed way to profit, but you are somewhat controlling your risk because you're not really taking a lot of directional bets. You do have directional risk when you're in these positions on and off, but you're kind of cycling them quickly, trying to profit on just the activity. The rewards token is a big differentiator here because you're getting a good chunk of these rewards tokens for participation in there. That's your incentivization. I'm hoping to learn from this. So I kind of view this sort of, many, many, many years ago when Bitcoin, I think, was trading, around a couple of dollars. I really thought it was cool that you could build these things, run mathematical computations and kind of try to overclock your hardware to get it to tweak out more maths, to do it better mining. I kind of, I learned a lot about the mechanics of cryptography and stuff like that way, way back in the day. I kind of equate this to a similar thing where this is like a little science experiment that I can run on my computer about, the macro view of how markets work, how market makers participate, what happens to bids, what happens to asks, what happens to participants, right? I can view all of this stuff. I can, tangibly touch it, feel it, and experience it. And so I don't plan on putting a large chunk of money in here at all, but just enough to throw some liquidity in there and see what happens, and do some tweaking and do some dialing of things, and just kind of learn a little bit more. Anyway, a lot going on out there in the market, so hopefully you find something that interests you, whether or not that's picking up the Hummingbot and learning a little bit about trading bots, whether that's scouring the latest earnings reports and the latest upcoming earnings to play that in the equities world, or maybe you're just dollar cost averaging into some sort of index. Whatever type of financial product that you're interested in, I hope you have great luck in the coming weeks participating in that. And remember, think outside the block.